deal we bought in Jacksonville in March for $27 million. We just sold it for $37.5 million last month. 9 or 10 months later, we almost doubled the investor equity. Now we could say, oh, we're really smart. That's really great. It was all our own. Like, we really didn't do a lot, but we bought in the right area. We bought in an area where the population is growing. I think in general, in some ways you say you can get lucky, but it's the idea that, I have friends that do stuff in northern markets, in LA and other areas. I don't do deals in these areas just because I don't see the demographic shifts. I don't see the population migration. I don't see the story even kind of making sense for that market. If you buy in the right area, you're going to be surprised as well about how it performs. We have another deal that we're doing in Florida where we're expecting $200 a month rent bumps and we're getting $350. And how did that happen? Well, some of it's just the area. Some of it's just the way that that's growing. But again, there's got to be a story. It can't just be you're coming in and we're just going to raise rents. There's nothing else. Like, no, we're putting this much per unit. We're seeing down the street or even in renovated units, we're seeing a $200 a month rent bump. And you just want to make sure that when you look at those numbers as a passive investor, that they are conservative, that they're not best case scenario and they're not worst case scenario.